Welcome back to the quarterly call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. All right, we're jumping straight into some really fascinating material today. We're looking at the big shifts happening in the semiconductor equipment world.
Okay.
Our goal here is to really break down the financial results from the September 2025 quarter, that's Q1 of this company's fiscal 26, and pull out what matters going forward.
hmm
We're hunting for those signals, the guidance that points to a real structural change in how investments are being made. And, well, spoiler alert, it seems like AI and geopolitics are the big stories here.
Yeah, it's definitely more than just, one good quarter. It feels like confirmation of something bigger, a longer-term trend.
Right.
I mean, that last quarter really set a high bar. Record revenues, record margins, too. And if you look at their projections, they're talking about closing out calendar 2025 with 3 quarters in a row above $5 billion in revenue.
3 consecutive quarters over $5 billion. That's
Yeah,
that's sustained strength.
It is. And that kind of momentum, it really suggests the industry isn't just riding the old consumer cycles anymore. It's shifting towards these foundational investments driven by enterprise needs, technological complexity, things like that.
And that structural investment idea, that's really what we want to dig into, because if margins are climbing alongside revenue, well, that tells you it's not just about shipping more boxes.
Right, exactly. It's about shipping the advanced stuff, the next-gen tech.
Okay, so let's unpack the numbers from that September quarter. They were impressive.
They really were.
Revenue hit $5.3 billion, right at the top end of their guidance range. But the margins, let's talk about those, because that's where you really see the operational strength shining through.
Absolutely. You have to look at profitability to get the full picture. Gross margin hit 50.6%.
50.6.
Yeah. And just for context, that's actually a record since the Novellus merger. When Lam bought Novellus, that combined company set a high standard. Getting back over 50% now, it shows real efficiency.
So efficiency, what else? Favorable product mix.
Definitely favorable mix. Means they're selling more of the high-value, complex tools, and probably strong pricing power, too.
And then operating margin. That hit an all-time company record, 35%. What pushed that number so high? Was it just leverage from the higher revenue and gross margin, or something else?
It's mostly a combination, but scale certainly helps. I mean, 35% operating margin is huge. That's competitive even outside this kind of heavy equipment industry.
Right.
It reflects, good control over operating expenses, OpEx. And critically, it shows how efficient they are at managing a really complex global supply chain, especially during these high-demand periods.
So they're managing costs even while presumably investing in things like R&D.
Yeah, exactly. They're absorbing necessary cost increases, like hiring more R&D folks, which we can talk about, while still getting the most profit out of each revenue dollar. It's really a sign of a mature, well-run business model.
Okay, let's break down where that revenue came from. The systems revenue, the actual equipment sales. Foundry was the dominant story, wasn't it?
It really was. A massive 60% of systems revenue came from Foundry. That's up from 52% just the quarter before.
Wow, 60%. And that was their third record quarter in a row for Foundry.
Third consecutive record, yeah. And that sustained growth, it's important because it tells you a couple of things.
Okay.
First, their strategic focus on the leading edge is clearly paying off. The nodes where the next-gen CPUs and GPUs get built, they demand the most advanced, most expensive tools.
Makes sense.
And second, and this is important context for the geopolitical angle we mentioned, that Foundry strength also included a significant chunk of mature node spending, specifically from domestic China.
Ah, okay. So that provided a lift maybe we won't see going forward.
Precisely. A margin lift that's, let's say, normalizing in the upcoming quarters due to recent changes.
Got it. All right, what about the memory side? That was, what, 34% of systems revenue?
34%.
Flush.
Slightly lower share than before, but the mix within memory tells the AI story.
Oh.
Well, non-volatile memory, mostly NAND flash, that was about 18% of systems revenue. But the real action was in DRAM. That increased to 16%, up from 14% the previous quarter.
And that DRAM growth.
Overwhelmingly driven by high bandwidth memory, HBM, the specialized stacked memory that sits right next to the AI chips.
The really fast stuff.
For really fast, low latency stuff. That growth is also helped by standard DRAM node migrations too, like the 1B and 1C nodes. Those are needed for the DDR5 transition in servers generally. So a couple of drivers there, but HBM's a big accelerator.
Okay, so the upfront equipment sales are clearly tied to complexity, to AI, to these advanced nodes. But let's talk about the stability factor, the Customer Support Business Group, CSBG. That seems like a really solid, consistent performer.
Oh, absolutely. The CSBG is kind of their recurring revenue engine. It comes from spares, services, and importantly, high-value upgrades on their huge installed base of tools out in the field.
And how did it do this quarter?
Brought in about $1.8 billion, just slightly higher than last quarter and also up year over year. That stability is just crucial for their financial planning, smooths out the cycles.
And they have that incredible track record, right? It's something like 13 years of growth since the merger, only missing 1 year.
That's the one. It's astounding, really.
Is that just because there are more tools installed every year, or are customers actually spending more per tool on these upgrades and services?
It's definitely both, but the leverage aspect is key.
Mm-hmm.
The growth in total CSBG revenue has actually been faster than the growth in the number of tools installed.
So higher spend per tool.
Exactly. That signals strong leverage. Customers are investing more in services, yes, but especially in those high-margin upgrades. They're using CSBG to basically extend the life and boost the capability of the equipment they already own.
So it helps the customer's bottom line, too.
Right. Drives reliability, boosts performance, and for the company, it maintains that high profitability. It's a really critical piece of their long-term growth picture.
Okay, let's pivot now to the big force multiplier, AI. The overall outlook for wafer fab equipment spending, WFE, for calendar 2025. It seems to be trending a bit better than they thought previously.
It does. Slightly better than the prior $105 billion view they had, which suggests, investment commitments are maybe accelerating a bit.
And what's driving that upward revision?
The main reason mentioned was better than expected investment related specifically to HBM, high bandwidth memory again.
It keeps coming back to HBM.
It really does. The demand there is just pulling forward investment cycles faster than, well, maybe anyone predicted. And zooming out, this is where we get that really striking metric about the AI impact.
Yeah, that number is incredible. Can you state it again?
Right. The estimate is that AI data center investments translate to roughly $8 billion of WFE spending for every $100 billion in incremental data center investment.
8 billion for every 100 billion. That ratio just sounds wild. Why is the equipment spend multiplied so dramatically compared to the overall data center cost?
Well, it boils down to physics and integration challenges. Think
Yeah.
about it. A standard server uses, pretty standard commodity memory and CPUs.
Okay.
AI, especially things like generative AI, needs massive parallel computing. That means the most advanced GPUs or custom accelerators, plus that ultra-low latency HBM we talked about, and also high-speed enterprise SSD storage. But the real kicker isn't just the chips themselves, it's how you connect them all together efficiently.
So this leads us straight into advanced packaging, things like 2.5D and 3D integration.
Precisely. You hit the nail on the head. To get data moving fast enough between that powerful logic chip, the accelerator, and its HBM memory stack, you just can't use old-school printed circuit boards. The connections aren't dense enough or fast enough.
So you have to go vertical or side by side.
Exactly. You stack the components vertically or you integrate them very tightly side by side using things like silicon interposers. And that kind of 2.5D and 3D integration, it requires dozens and dozens of extra, highly specialized deposition and etch steps.
Steps that a normal 2D chip just wouldn't need.
Correct. Steps to create all those tiny, fine-pitch vertical interconnects, the through-silicon vias, the redistribution layers, and these steps use the highest value, most differentiated deposition and etch tools in their portfolio. That's the core of the multiplication effect.
So it's not just that overall WFE spending goes up with AI, it's that the type of spending shifts towards areas where this company is particularly strong, expanding their slice of the pie, their served available market, or SAM.
Absolutely spot on. Every one of these advanced processes, whether it's gate-all-around, GAA, transistors and logic, or stacking HBM cubes, or building hundreds of layers in 3D NAND, every single one requires proportionally more deposition and etch steps.
More layers, more steps.
More layers, more steps, more complexity. So the demand for these intricate 3D structures means that their SAM, as a percentage of total WFE, is projected to grow. They see it going from the low 30% range up towards the high 30s over the next few years as these nodes ramp.
So they're structurally capturing a bigger piece because the technology bottlenecks are shifting right into their sweet spot, deposition and etch.
That's the essence of it. That's the $8 billion multiplier in action.
Now, it's easy to get caught up in these huge long-term announcements, hundreds of billions for data centers over many years. How does that translate into actual orders for equipment today? How do we square those long-term visions with near-term demand?
Yeah, that's a good question. Yeah. Those big multi-year $100 billion data center plans, they're crucial as guideposts,
Yep.
right? They give everyone visibility into the long-term direction of spending from the cloud giants and major enterprises.
Sets the destination.
Exactly. But the actual orders landing today, the near-term demand, that's driven by immediate concrete needs.
Okay.
What we're seeing now are orders focused on things like enterprise SSDs needed for current data center expansions.
Okay.
We're seeing orders tied to specific technology transitions that are happening right now, like the early ramp of GAA and logic foundries, and of course, the urgent need for more HBM stacking capacity today.
So customers plan based on the guideposts, but order based on today's factory utilization and the need to get to the next node.
Precisely. They have to migrate now to meet current performance demands, even as they plan for that longer-term build-out.
Okay, let's take that idea, current needs and transitions, into the memory market, specifically NAND flash. The big story there still seems to be this massive conversion trend, right? Customers upgrading existing fabs to make devices with like 200 plus layers.
Yeah, that's probably one of the clearest long-term tailwinds for them. The company's estimate is pretty staggering. Just upgrading the existing installed base of NAND fabs, not even building brand new factories, just converting the old ones. That's going to require over $40 billion in WFE spending over the next several years.
40 billion just for upgrades.
Just for upgrades. And given their historical strength, their dominance really in NAND etch and deposition, they're incredibly well positioned to capture a big chunk of that $40 billion conversion spend.
That several years timeline for the $40 billion, does it feel like that might be speeding up? If DIT demand, storage demand is trending higher than expected.
Oh, it absolutely accelerates it. Think about data centers needing bigger and bigger SSDs. 256 terabyte enterprise drives are becoming the target.
Right.
To get those capacities efficiently, you need more layers for density, and you need better performance. So this rising demand basically shortens that several years window for the $40 billion.
It forces the upgrade sooner.
It does. You can kind of think of this conversion spending like taking a solid existing car frame and upgrading the engine, the transmission, the electronics, everything inside. It's much faster than waiting 3 years for a completely new car factory to be built from scratch.
It's the quickest path to more bits, more performance.
Exactly. It's the fastest, lowest cost way for the industry right now to get that needed bit growth and performance boost by leveraging the huge installed base they already have.
And we're seeing their technology leadership in this area getting recognized too, right?
Yeah, the Semi Award they got in 2025 for their Lam Cryo 3.0 dielectric etch technology. That's a perfect example.
Cryo 3.0.
Right. That tech is now basically an industry standard for doing the incredibly deep, high aspect ratio etching needed to, drill those tiny vertical channels through hundreds of NAND layers. Winning that award just highlights their sustained edge in the really core processes needed for 3D stacking.
So with demand accelerating, is the focus still mainly on these conversions and upgrades? Or are customers finally starting to pull the trigger on building brand new empty fabs, greenfield capacity?
For now, and likely through 2026, the priority remains upgrades. That conversion spend we talked about, it's just significantly faster and cheaper for the industry to get more bits by repurposing existing fabs.
Okay.
However, there is a potential bottleneck, a hard limit, really.
Which is?
Clean room space, just physical floor space in the existing facilities. If bit demand stays this strong, this accelerated, the industry might actually run out of room in the current fabs to do more conversions.
So they might be forced to build new fabs sooner than they thought, even while upgrades are still happening.
That's the potential scenario. It could force customers to start planning and building new capacity, new shells, sooner than previously anticipated. That could be a potential upside kicker for WFE spending maybe in the 2027 timeframe. Something to watch.
Interesting. Okay, looking at specific wins in NAND right now, what technologies are really showcasing their lead, especially as we talk about going beyond, say, 500 layers?
Well, one key win they highlighted was at a major NAND maker for high aspect ratio dielectric deposition. This needs really specialized conformal fill capability using a higher temperature process to coat those deep trenches uniformly.
Okay, deposition is critical. What about the metal layers?
Yeah, maybe even more telling is the metal side. Their Halo Moly ALD tool, that's atomic layer deposition using molybdenum, has apparently been chosen as the tool of record for 3 nodes in a row at a leading customer.
3 nodes, including the really high layer counts.
Including devices aiming for over 500 layers, yes. That Halo tool's ability to deposit molybdenum is fundamental for building the word lines in advanced 3D NAND. It's absolutely essential for making those high-performance enterprise SSDs we keep talking about.
So dominance in both the etching and the critical deposition steps for stacking.
That seems to be the picture, yeah.
Okay, shifting slightly beyond traditional memory. The AI boom is also driving huge demand for advanced packaging tools, right? Tying back to that 2.5 D3D integration.
Oh, absolutely. They're seeing really strong demand for tools like their Sabre 3D plating systems and their Syndion etch system.
Sabre and Syndion.
Right. Those are essential for creating the superfine features, the bumps, the pillars, the interconnects you need in these complex 2.5D and 3D packages we discussed earlier.
You just can't connect the AI chip to the HBM without them.
Basically, no, not efficiently. Without these advanced packaging tools and processes, you can't integrate those huge logic dies with the high-speed memory they need.
And as these AI chips, these high-performance computing chips just keep getting physically bigger, integrating more and more stuff, the industry is starting to think about manufacturing differently, isn't it? Which leads to this idea of panel-level packaging, PLP.
Exactly. PLP is emerging now because the traditional 300 millimeter round silicon wafer just isn't ideal anymore for these massive, complex, system-in-package devices.
Why not? Just size limitations.
Size and shape, really. The chips needed for AI might integrate, dozens of accelerator chiplets, multiple HBM stacks. They're becoming physically huge. Trying to dice those out of a round wafer gets increasingly inefficient. You waste a lot of space around the edges.
So panel-level packaging moves away from the round wafer.
Right. It shifts the whole process from that 300 millimeter round format to a large rectangular panel format. Think more like a big sheet of glass used in display manufacturing.
Ah, okay.
Like making TVs.
Yeah, kind of analogous, yeah. This lets manufacturers process multiple large units, or one really huge unit, simultaneously on a big rectangular surface. It drastically improves manufacturing efficiency and yield for these enormous integrated devices. It's seen as a necessary step for scaling AI hardware manufacturing in the future.
And it sounds like they're moving pretty aggressively on PLP.
They are.
Yeah.
They mentioned collaborating across the industry to help drive standardization, which is always crucial for a new technology format like this. And they expect to finish this year with PLP tools either installed or already shipped out to about 20 different customers worldwide.
20 customers already. That suggests they're building capability fast, ahead of wider adoption.
Yeah, it indicates they're establishing a strong position in this emerging field pretty quickly. Could be a really significant market down the road.
Okay, we've talked about the strong performance, the AI drivers, but we need to balance that with the headwinds. The financials we discussed earlier were incredibly strong, yes, but part of that strength came from a regional mix, specifically China, that's now changing quite dramatically because of geopolitics.
Right. This is the necessary reality check in the forward guidance. We have to talk about the impact of the recently announced U.S. restrictions, specifically that 50% affiliate rule.
And that rule directly impacts shipments to certain customers in China.
Yes, it significantly restricts shipments to certain domestic China customers, and the impact is immediate and quantifiable. They're forecasting roughly a $200 million hit to revenue just in this current December quarter because of it.
$200 million just in Q4. And looking out to the full calendar year 2026?
The projected impact for calendar 26 is around $600 million in lost revenue potential compared to what might have been otherwise. So yeah, it's substantial. And it fundamentally changes the regional revenue picture for them.
How significantly?
Well, China was huge. In the September quarter, we analyzed 43% of total revenue. But crucially, as we noted before, that strength was really driven by domestic Chinese customers investing, mostly in mature nodes.
Yeah.
Investments in China by the big multinational chip makers actually stayed pretty steady.
Okay.
So as a direct result of these new restrictions hitting those domestic players, the forecast is that China will represent less than 30% of their overall revenue in calendar 2026, down from 43%.
Wow, that's a big shift, less than 30%. Where does that revenue get made up?
It's expected to be offset by robust strength from the global multinational chip makers investing heavily in leading-edge nodes outside of China. So a geographic shift in investment.
Now, this normalization, as you called it, of the China revenue mix, that domestic China business, particularly in mature nodes, often carried pretty favorable margins, didn't it? Maybe less R&D intensive than bleeding-edge tools.
Generally, yes. Slightly more favorable margins.
So losing some of that mix is going to be a headwind for profitability, right?
Absolutely.
Yeah.
That favorable margin mix is normalizing back down. And you combine that with the increasing cost of, materials and components due to rising global tariffs.
Mm.
It puts pressure on the gross margin forecast.
And that's reflected in the guidance.
It is. The guidance for the December quarter reflects this drop. They're guiding gross margin to a still very strong but lower 48.5%. And we also need to factor in some changes on the tax front.
Right, you mentioned taxes, an expected increase in the effective tax rate for 2026. What's behind that?
It's mainly driven by two global policy shifts, really. First, in the U.S., the rate for GILTI is increasing.
GILTI.
Yeah, global intangible low-taxed income. Basically, it's a sort of minimum U.S. tax on certain profits earned overseas by U.S. companies. That rate's going up.
Okay.
And second, there's the implementation of the global minimum tax regime. You might have heard it called Pillar 2. This basically forces large multinational companies to pay a minimum tax rate wherever they operate around the world. Both of these things together are expected to slightly increase their overall effective tax burden next year. Okay, so we have geopolitical headwinds causing a $600 million revenue impact from China, some gross margin pressure, slightly higher taxes. Given all that, what's the overall expectation for WFE spending growth in 2026? Does it still grow?
Yes, the market expectation is still for overall WFE growth in 2026. But the timing of that growth looks different now.
How so?
The first half of calendar 2026 is projected to be roughly flat, maybe slightly up, compared to the strong second half of 2025 that we're in now.
Flat to slightly up in the first half.
Right. Which means that the WFE growth for the full year 2026 is going to be heavily weighted towards the second half of the year.
Why the back half weighting?
Well, typically, some of those restricted domestic China entities would have placed orders that were weighted more towards the first half of the year. So their absence creates a bit of a dip or plateau initially. That gets filled in, and then growth accelerates as the big multinational CapEx plans really kick into high gear throughout the back half of 2026. Okay, that makes sense. Let's shift focus then completely towards the technology that's going to drive that future high margin revenue, the product roadmap, the differentiation at the really advanced nodes. EUV patterning seems like a key battleground.
Oh, definitely. And the focus for them here is on their Aether dry resist EUV patterning solution.
Ether.
Yeah, this is really foundational tech for manufacturing anything below, say, 10 nanometers. What makes Aether stand out is its ability to resolve features smaller than 15 nanometers with incredibly high precision, high pattern fidelity. Think of it like painting extremely fine, perfect lines at a microscopic scale.
And the benefit isn't just making smaller things, right? There's a big economic plus, too.
Huge economic benefit. Aether allowed for a greater than 10% reduction in the EUV exposure dose needed.
Okay, why does dose reduction matter so much?
Because the EUV scanners themselves, the lithography machines, they're unbelievably expensive, probably the most expensive machines on Earth. And they're also relatively slow compared to older methods.
Got it.
So if you can reduce the amount of light, the dose needed for each exposure by 10% or more, you effectively boost the productivity, the throughput of that multi-hundred-million-dollar scanner by 10%.
Which directly lowers the cost per wafer for the chipmaker.
Directly. It's an immense economic lever. Makes the whole process more viable.
And this Aether technology, it's not just theoretical, it's being adopted.
Yes, they mentioned it's currently ramping into high-volume manufacturing in the HBM production line of a major memory maker. So that highlights its use right now for complex stacked memory.
And looking ahead, where else is it critical?
Well, looking forward, Aether is positioned as being really critical for the industry's next big leaps. Things like the transition from gate-all-around or GAA transistors to the next structure called CFET in logic and foundry chips.
GAA to CFE.
Right. And also for the migration in DRAM from the current 6F squared cell architecture down to a denser 4F squared architecture, especially when you combine these shrinks with the next generation of EUV, the high-NA EUV scanners.
Okay, for listeners maybe not deep in the manufacturing weeds, can you quickly explain that GAA to CFE transition? Why is it necessary, and why is Aether key there?
Sure. So GAA gate-all-around is the current leading-edge transistor design. The gate material wraps all the way around the channel, gives great control, reduces leakage current. But to keep shrinking, keep packing more transistors in, manufacturers need even more density.
Right.
CAT, or complementary field effect transistor, is seen as the next logical step. What CAT does, it vertically stacks the two types of transistors, the N-type and the P-type FETs, right on top of each other.
Stacking the transistors themselves.
Stacking the actual transistors vertically. This allows for much higher density on the chip without increasing the footprint as much. But building that vertical stack requires incredibly complex, high aspect ratio patterning steps, especially when you're using a high-NA EUV for the finest features. Aether's precision becomes essential for reliably defining those sub-10 nanometer features in that really challenging 3D landscape.
Sounds incredibly complex. And these kinds of transitions need the whole ecosystem working together, right? Materials, suppliers, tool makers.
They absolutely do. And on that front, they announced a collaboration with JSR Corporation. Specifically, they're integrating Aether with JSR's novel EUV patterning materials, things like metal oxide resists.
Okay.
And beyond that, they're also partnering with JSR to explore totally new precursor materials for advanced atomic layer deposition, ALD, applications.
Okay.
This kind of co-development is vital. It ensures the process tools and the chemicals they use evolve together, hand in hand, so they can maintain that differentiation when the industry hits the next big inflection point.
Speaking of ALD, atomic layer deposition, they highlighted a key solution there for a really stubborn problem in scaling, didn't they? Performance degradation because of rising capacitance.
Yes, that's a fundamental physics headache. As you shrink transistors and logic chips, the different parts get closer together and you get more unwanted electrical interaction, higher capacitance, especially in the gate module. This degrades performance, increases power consumption.
And it happens in DRAM, too.
Yep, similar issue in DRAM. As you shrink the memory cells, the capacitance between the bit line and the storage capacitor contact goes up, and that can impact reliability, how well the memory holds its state.
So the solution is to use better insulating materials, these low GaN films.
Exactly. You need materials with a low dielectric constant, low K. These act as better insulators. And for modern chips, these films need to be incredibly thin. We're talking less than 5 nanometers and absolutely perfect defect-free.
But the traditional ways of depositing these films, like in big batch furnaces, they struggle at these dimensions, don't they? The films end up being too fragile.
They really do. Furnace-based low kilns often lack the perfect uniformity you need when they're that thin. And critically, they tend to be structurally fragile. They just can't survive the harsh chemical etching and cleaning steps that happen later in the manufacturing flow. The film basically gets damaged or just peels off to laminates.
So how does Lam's ALD solution get around that? How do they make a low-K film that's super thin but also tough enough?
Their approach is quite different, highly differentiated, they say. They use a unique single-wafer reactor design that uses a remote plasma source.
Remote plasma.
Yeah, the plasma, which provides the energy for the deposition reaction, is generated away from the wafer surface itself. This creates a much gentler deposition environment for the wafer. Combine that with a novel precursor chemical, and they can deposit these ultra-thin, less than 5 millimeter Loc films that are remarkably defect-free and also durable.
Durable because the deposition process itself is less aggressive.
Essentially, yes. It allows for the precise silicon-carbon bond structure needed for good insulating properties and physical toughness. Because the process is gentler and precisely controlled on just one wafer at a time, the resulting films are strong enough to withstand all those tough downstream processing steps, the harsh chemistries.
And this is leading to wins.
Apparently so. They mentioned this breakthrough has secured critical design wins at both leading foundry logic and DRAM customers for these crucial low insulating layers. It's solving a key scaling bottleneck.
This constant innovation, developing things like Aether and this low-K ALD, it obviously requires sustained investment in R&D. What's their approach there?
Yeah, it remains a top priority. They stress their continuing strategic, very targeted investments in R&D, and just in the September quarter alone, they increased their R&D headcount by about 400 regular full-time employees.
400 people just in R&D in one quarter.
Right. That kind of expansion is essential, they argue, to support the long-term product roadmap. They're focused on developing the next generation of their core platforms. Names like Vantex, Akara, Halo, Dextra were mentioned. They're basically staffing up now to tackle the big technological challenges and inflection points they see coming over the next, say, 5 years or so.
Okay, let's try and bring all these threads together for a concluding outlook. Despite that significant, quantifiable $600 million geopolitical hit from the China restrictions, the overall picture still seems to be setting up for strong WFE growth in calendar 2026. Is that fair?
I think that's fair, yes. The underlying strength seems to be a structural story now. The demand for leading-edge technology across the board is just so strong that it's basically overpowering that decline in domestic China spending.
Driven by?
Driven by the growth in leading-edge foundry and logic, things like GAA moving towards CFE. Driven by the continued acceleration of HBM adoption in DRAM. And driven by that massive necessary $40 billion plus wave of NAND conversion upgrades. All those factors combined look set to ensure WFE goes next year. It really speaks to just how essential advanced computing has become.
And financially, even while they're making these big R&D investments, they're staying focused on shareholder returns.
Yeah, financial discipline seems to remain paramount. They explicitly reaffirmed their commitment to return at least 85% of their free cash flow back to shareholders over time,
85%.
at least. And we saw proof of that commitment this past quarter. They spent nearly $1 billion, about $990 million, on share buybacks through open market repurchases. And that's alongside the dividend, which they also recently increased. So yes, they seem focused on managing growth and returning capital at the same time.
Okay, this whole conversation has really been dominated by the sheer intensity of technology transitions and the incredible acceleration driven by AI demand. It kind of begs one final, maybe provocative question for you to think about.
All right, let's hear it.
If these high demand areas like AI just keep pushing technology requirements faster and faster, creating these huge multi-billion dollar WFE opportunities we've discussed, could the physical constraints become the ultimate bottleneck? I mean, things like just building the factories, the clean room space needed for all these new tools, could that actually limit WFE growth more than the technology itself? Or will things like density improvements and conversion upgrades always find a way to bridge the gap?
Yeah. That is probably the central strategic question, maybe the biggest challenge, facing the entire semiconductor supply chain over the next 5, maybe 10 years. Historically, technology density, Moore's law, basically getting more transistors, more storage, more performance per square millimeter, that has always kind of rescued us, right? Found a way to keep things moving.
Right. We always found a way to cram more in.
Exactly. But the rate of demand acceleration we're seeing now, particularly for these highly customized, complex 2.5D, 3D packaged AI chips, it's so incredibly rapid. It's possible that the sheer physical infrastructural time lag, the years it takes to permit, build, and equip a massive new leading-edge cleanroom facility, might actually become the true limiting factor for a period.
So the construction timeline could dictate the pace.
It could. If that $40 billion NAND conversion spend, for example, eventually hits a hard wall because there's just no more suitable floor space in existing fabs, then yeah, the pace of new facility construction, which takes years, could potentially dictate the maximum pace of WFE growth for a while, almost regardless of how fast the technology itself is ready to advance. It's a fascinating dynamic to watch unfold.
A fascinating dynamic indeed. Food for thought. Thank you so much for tuning in to the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.